We enter a new era here in the US, or should I say a familiar era, as President Donald Trump is yet again back in power. And as you manage your own portfolio, regardless of your political affiliation, it's important to understand the ramifications a new administration could have on your portfolio. However, let me dampen things here for a moment because it's important when you manage your own portfolio to understand the risks ahead of us. One of those risks is valuation. Only 2 times have we seen the S&P 500 with valuations this high. Number one, the post-pandemic surge that we saw, and before that was the dot-com bubble. Number two is going to be around inflation. We continue to see very sticky inflation, and none of these go in any particular order. But number three is going to be a major debt crisis that we have on our hands here in the US, and with the Federal Reserve not looking to cut rates as many times as many initially thought was going to happen, that could have an impact on a number of different companies. So a few things to think about right there. But on the flip side, we have an administration that's going to enact pro-growth policies, America First policies. This appears to be less regulation, a pro-crypto and energy first here administration. So all of these things could impact your portfolio in some shape or form. With that being said, and scanning different valuations with different companies in various different sectors, I found 3 stocks that look incredibly cheap at today's level, and that's what we're going to be focusing on in today's video. All 3 of these companies come from various different sectors within the S&P 500, and we're going to talk about them today. But before we do, show your appreciation for the research by simply clicking that like button down below. Subscribe to the channel, and let's jump into it. Hey everyone, Mark Rusin here, back for another video. As always, I'm a CPA and not a financial advisor, so please do not take this as financial advice. And before we begin, let me thank today's video sponsor, which is the Motley Fool. The Motley Fool has a ton of great resources and products available for investors of all different levels. And right now, if you go to fool.com/Mark, you could check out their 10 best stocks to buy right now. All right, let's jump back into our video, taking a look at 3 stocks that look incredibly cheap at today's valuations. Beginning with cheap stock number 1, which is going to be Shell, stock ticker SHEL. One of those areas that I was upbeat on that I believe this administration is going to focus on is going to be energy, and Shell is a major energy player. When looking at the sector performance back in 2024, energy was one of the worst performing sectors, gaining less than 2%. But we have already, since the re-election of President Trump, started to see a refocus on energy. When it comes to Shell, they are an energy giant, operating out of the oil and gas industry with a market cap of $208 billion. And over the past 12 months, shares are up just 9%. However, they're down 11% from their 52-week highs. So why am I upbeat on Shell? Well, I already talked about that a second ago because this administration is going to again be focusing here on American energy companies. The other is the refocus more on LNG, or liquefied natural gas. In fact, the Shell management team believes that LNG demand is going to grow by 50% by 2040. Do you happen to know who one of the leaders are in the world when it comes to LNG? That's going to be Shell. There could be a huge amount of upside just in that particular area of the business. And it's not something that's going to happen overnight. It's going to take time. The company has improved its balance sheet over the past few years, as the current and quick ratios have increased from 1.37 and 0.75 respectively a few years back to 1.4 and nearly 1 in 2024. In terms of valuation, analysts are looking for the company to generate 2025 EPS of $7.55 per share, which equates to a forward PE multiple of just 8.8 times. This is very favorable to their 5-year average of nearly 10 times. But if you look at what this company traded at under the first Trump administration, the average PE multiple was at 18 times. So this stock is cheap based on the 5-year, but extremely undervalued when compared to the Trump 1.0 administration, which is rather intriguing. In addition, the stock pays a juicy 4.1% dividend yield that will add to your total return. Analysts rate the stock a strong buy with an average 12-month price target of nearly $80, implying nearly 20% upside from current levels. Cheap stock number 2 is going to be Danaher Corporation, stock ticker DHR. Danaher isn't a company that we've talked about on this channel, but it was rather intriguing when I was performing my research on it. And if you're interested in not only seeing my research, but my personal portfolio, then consider subscribing to the Stock Investor's Edge, the premier investing newsletter on the market today. You can sign up and see not only stock deep dives, my portfolio, trade alerts, but so much more. Check out the link down in the description below. But getting back to Danaher, this is a company that operates out of the healthcare sector, building life science and biopharma tools and products. They currently have a market cap of $172 billion, and over the past 12 months, shares are up 6%. However, they're down 15% from their 52-week highs. Like many companies in this particular field, revenues and earnings have been quite volatile post-pandemic, still trying to find their regular footing. Revenues reached a high of $26.6 billion in 2022, but those are expected to drop to $23.86 billion for fiscal 2024. The company's expected to report earnings here in a week and a half at the end of January. So if you do not yet own the stock, it may be best to get an update on their latest results before looking to enter. Earnings for the company have been just as bumpy, reaching a high of more than $10 per share a few years back to now looking to earn $7.51 for 2024. Like we saw with energy when talking about Shell, when it comes to Danaher and healthcare, healthcare was another sector that was beaten up rather hard back in 2024. And I regularly like to look for high-quality companies, gems in beaten-down sectors. In terms of valuation, analysts are looking for the company to generate $8.15 per share this year, which would equate to 9% year-over-year growth. And that would give the company a forward PE multiple of 29 times. This is below their 5-year average of 32.3 times. Shares look like a great entry point, especially as growth is expected to pick up this year and even more the following year when analysts are looking for 12% earnings growth. Management also operates this company very efficiently, as this is a company that generates 30% or higher EBITDA margins over the trailing 12 months. In addition, the company pays a slight dividend of 0.5%, but not a reason investors should ever invest in this particular stock. But it has shown its ability for strong dividend growth, as they have a 5-year dividend growth rate of 12%, and they've actually grown the dividend for 11 consecutive years. Analysts rate the stock a moderate buy with an average 12-month price target of nearly $283, implying nearly 20% upside from current levels. And that leads us to cheap stock number 3, which is going to be ASML Holding, stock ticker ASML. Now, I already know I'm going to get comments like this, so let me just nip this in the butt right now. When I talk about a cheap stock, far too often people focus on the stock price. Now remember, if I'm investing $500 into 2 different stocks, $500 into stock 1, $500 into stock 2. Let's say stock 1 trades at $500 per share, so I can buy myself 1 share. But stock number 2 trades at $50 per share, which means I can buy 10 shares of that company. There's no difference here, folks. I still have $500 invested. And if both of these companies increase by 10%, it's not going to matter whether I have 1 share or 10 shares. I have $500 invested. That is what's going to increase by 10%. Cheap is more focused on valuation. So with that disclaimer out of the way, let's take a closer look at ASML, which operates out of the technology sector, and they build semiconductor equipment. They currently have a market cap of $293 billion, and over the past 12 months, shares are up just 6%. However, they have fallen hard, down 32% from their 52-week highs. This is a stock that once traded over $1,100 per share. With the Trump 2.0 presidency now underway, one area that I believe is going to continue to see heavy investment in is going to be that of AI. So these Mag 7 stocks that are heavily investing in AI are going to continue to be winners, especially over the past few months leading up to this presidency, or this inauguration, I should say. You've seen a lot of these big tech company executives really starting to cozy up to the new president. So when it comes to investing in AI for your portfolio, there's a number of different routes to go. There's chip makers, there's software companies, but I'm going to go a different direction, and I'm going to look at a key equipment maker. Today's very powerful but also lightning fast chips take a special EUV machine to build. one that really only ASML offers, giving the company a wide moat. Intel, Samsung, and Taiwan Semi especially are three of the largest customers for ASML. And as they continue to build new plants and expand capacity, this is going to directly impact in a positive way ASML. So what happened to the stock, you might ask, for it to fall more than 30% off its 52-week highs? Well, first is if you go back a quarter or two, we saw the bookings fall by nearly 50% from the prior quarter. But the thing to remember when it comes to companies like ASML is this sector and this particular industry is very cyclical. So let's unpack this. First is that cyclicality business. But they also do large amounts of business in China. And with export controls coming in, China put through a huge amounts of orders in prior quarters, hence the drop in bookings. What has not changed is the company's strong margins. Gross margins are at 51%, operating margins at 31%, and EBITDA margins have come in at 34% over the trailing 12 months. So a key risk here when thinking about ASML is definitely going to be their business with China, but also China investing heavily on trying to build their own EUV machine as well. Looking here at this fast graphs chart, it's important to note that over the past 5 years, shares have traded at an average earnings multiple of 39 times, and over the past decade, closer to 35 times. Looking ahead, analysts are looking for 22% earnings growth this year and 23% earnings growth the following year. This gives ASML a forward PE multiple of 30.8 times, well below their 5 and 10-year historical average. It also gives the stock a PEG ratio of just 1.3, which I like to see stocks having something below 1.5. When it comes to analyzing stocks, one key metric and focal point for me is always going to be on free cash flow. And when you look at this free cash flow multiple, this is the cheapest that you've been able to buy this stock outside of the major 2022 crash since 2018. ASML also pays a slight dividend, as the company has a 0.9% yield, but they do have fast dividend growth with a 23% 5-year dividend growth rate. Analysts also rate the stock a moderate buy with an average 12-month price target of $860 per share, implying 14% upside from current levels. So there we just looked at 3 stocks that all appear cheap based on my evaluation of them. Definitely perform your own due diligence. And in the comments section, let me know which of these 3 stocks would you buy at current levels. I tried to give you 3 different companies from 3 different sectors. We looked at a technology company, an energy company, and then a healthcare company as well. So I hope you enjoyed today's video. And if you haven't done so yet, please show your appreciation by simply clicking that like button down below. Subscribe to the channel, and we'll see you in the next one. Take care.